Hey there, everybody. Welcome back to another 21st Century Renaissance and another open interest newsletter breakdown on GameStop. I'm your host, Dr. Michael LoPiano. Today, we are wondering whether some of this continued bullishness is going to keep doing some of that continuing into this week and a bit, out of into the end of May and certainly into June OPEX. So we're looking at some of our measurables that we look at on a regular basis, try to understand what's going on there, especially what might be happening with some upcoming FTD and CAT equity error settlement dates. So that's coming up today. Before we get to that, though, we are going to start with our gratitude. And today's gratitude goes out first and foremost to AmGo Blue, Adam Graff, for sponsoring today's article and video breakdown, as well as to our monthly supporter, Not Medical Advice, for helping offset some of my data expenses on a monthly basis. Thank you to everyone who has supported the channel in the past, whether that be through donations or through just asking great questions, right? You guys ask great questions. We had a great time on Friday's live stream thinking about what's coming up this week. So definitely, if you missed that, make sure you pop in, check out, right? We worked on some breakdowns of trading strategies as well as how I go about using various forms of data, right? You can do this on your own. You don't necessarily just need me to report this to you. You can take a look at some of this data on your own as you're planning out your trades, as you're planning or trying to build your own working model, especially of price action and how that works. So if you're certainly interested in learning some more of that, if you didn't have a chance to stop into the live stream on Friday, I'd highly recommend that you go check out the recording there. So today I would say, right, so what we're thinking about, so sort of in line with some of these principles that we talked about on Friday, right? So we approach the options market, and the options market is going to tell us a lot about what happens on a regular basis in a kind of isolated system, right? So the positioning of our options data, our OI, gamma exposure in particular, the gamma and delta exposure of these options contracts is largely what is going to affect how our price moves as different traders come in, open new positions throughout the day. That's what's going to push the price around. However, we also have this other thing to be concerned about, and that is a sort of injection of buying or selling pressure into that options environment, that closed egg of options, right? So thinking about what some of those might be and trying to anticipate those is crucial for understanding how certain trends may indeed reverse on GameStop, since we know, right, it's not necessarily, right, when GameStop reverses its particular trend, this is not necessarily the cause of a genuine desire to sell portions of the company, but is rather, in some cases it is a genuine desire to purchase the company, right? Shares of the company, but this occurs as a result of either a liquidity injection via available lending liquidity that then gets internalized and bounced around ETFs, or as an injection of buying pressure as the result of needing to settle these strategic ETF fails to deliver. So the end of last week was a very exciting week. Because we got new FTD data. So we got the FTD data for the end of April, and we also got our monthly CAT equity error update. And we did have some very interesting dates there. So right here on the cover here, right, what stands out immediately is that on the 15th, right, so the 15th of April, we had 1.2 million, over 1.2 million fails to deliver on XRT, whose settlement deadline is tomorrow. Now, with these settlement deadlines, it can often be a little bit difficult to anticipate exactly, like, down to the day when that volume is going to get processed on the lit market, and fails to deliver will end up being cleared, independent of this whole ETF musical chairs deal. We do have a working theory right now that as we approach the end of quarters, especially whatever is going on around June, because ETFs, especially ETFs like XRT, have their quarterly reweighting, I should say not quarterly reweighting, but their annual reweighting occurs at the end of June. It may even be biannually. But in any case, there is a reweighting that occurs 3 business days from the end of June for XRT. So as we get closer, right, to that deadline, it can be important and has been important for institutions to be able to manage fails to deliver and their internalizations and expectations to internalize orders with respect to XRT as we get closer to that deadline, right? You don't necessarily want to have a whole bunch of FTDs that you gotta close, you gotta settle them, lining right up with that reweighting day, because that can cause that can cause some headaches and get you blown out of a position, maybe mess up your margin, something like that. So this is something that I definitely have my eyes open for going into this week, right? Later in the week, then we had another 626,000, so about half, just about half, almost exactly half, popped up again on the 17th. So we've got these 2 days here, so the 15th, the 17th. Richard Newton's done a really awesome job these past few years putting together his data sheet, his Excel sheet that contains a master list, compiles all this FTD and ETF information from a number of different funds. He did a really great job pointing out just how many funds had a bunch of these FTDs that were juggled around in concert with these CAT equity errors that were just published last week as well. So if we bop on over there, we can see, thank you, very happy to have all these tools, Adobe. We can see that in the market-wide here on these same days, right? On these same days. So XRT, we had the 15th and we had the 17th, right? What we have here is the 14th and the 16th. We have a huge number of CAT equity errors. In fact, we also have some on the 15th. So between the 14th and the 16th, we have over 7 billion CAT equity errors. So last week, right, we had about 77 billion that were supposedly due to be cleared, which is a tremendous amount. That's about 10 times this, but 7 billion, that still corresponds pretty heavily. Region Formal over on Reddit's done a great job tracking the correspondence, the correlation between CAT equity errors in the billions over a several day period and upward price mobility in GameStop. So we're keeping that in mind. We're taking a look at those equity errors. Love to see that alignment right with those CAT equity errors and our favorite ETFs. That tends to suggest that some of those equity errors are indeed occurring in concert with what is going on with this liquidity engine over in our favorite ETFs. In fact, we saw shares to borrow in XRT multiple periods last week shot down to zero. We also saw the new ETF GME. So this is the Tuttle Capital T-Rex 2X Long GME ETF. And as we can see, right into the end of last week, almost down to zero, down to 48 shares. Now, the outstanding on this isn't even quite 3 million. There are not a lot of shares available to borrow of this ETF in general. But what is impressive about this, right, is there is a crazy high borrow rate. I mean, this thing is basically a credit card. And it was borrowed absolutely to the gills on Friday. So very interesting to see it doing that sort of thing, doing the XRT shuffle. As we know, XRT also has a pretty big shuffle, right? It tends to shoot on down there to zero. So for example, let's see what we're looking at today. We get the shuffle. We got a little bit of the shuffle from 350,000 pre-market or 400,000 pre-market down to 95,000. That's not crazy. We're used to seeing in excess of 90%, right? We're used to seeing something like this. It just shoot down to zero. This occurred several times last week. So that was very interesting to see pop out there. All right. So let's go take a look. Let's see if we can make sense of basically what the structure of our price action is going to be based on this particular an options modular understanding of how it's going to work, and then try to understand how these externalities might affect us as they do, right, and as we do here on a regular basis. So let's pop back over here. What can we say overall about markets? So understanding the market context is very important. On the one hand, to understand what other types of outflows, right, so might have to do. Outflows and inflows of ETFs may have in terms of an effect on GameStop's price action. So in general, we have observed that when the market is stable or especially bullish, right, bullishness tends to correspond with stability. SPY doesn't typically go sideways. It goes up or down in a macro trend. So with SPY, with the S&P 500, we have noticed that in bullish sequences, which corresponds to low volatility, we tend to see GameStop also do much better in terms of its price action. But with extended moves to the downside, that tends to make it, historically has made it a little bit harder for GameStop to have its own sort of bullishness. A potential exception to that does seem to be what occurred during that April 2nd big crash. Right, the Liberation Day tariff announcement, right, which was driven by whatever it happened to be driven by. GameStop did fare pretty well there, but GameStop, in fact, had already sold off pretty heavily as a result of this shorting, ostensibly as a result of the convertible bond arbitrage trade Certainly likely in some way to do with the swap rolling on 328 and 331, of which we know that there were some considerable positions. So GameStop basically had already had that sell-off and then performed very well when the rest of the market dropped. But if we take a look at the market as a whole, right, what could we anticipate going forward into this week? It does look like we're going to have a retrace. So we talked about that coming out of May OPEX. May OPEX was a very large positive gamma expiry. In fact, it was very interesting to see Moody's come out and downgrade U.S. credit right around the deadline of the SPY options print, so that all of this call GEX was conveniently wiped off the board, and therefore all of its hedging, stabilizing the volatility of the market, was gone, and we immediately transposed down about $6 in the S&P 500. So we did move down a bit pre-market, so into the upper 580s. What I would say, just very succinctly, is I would think something of a correction here down to where we have our 200 and 100-day moving average. So that's about 575. So we can see that on our daily. On the weekly, we can see it as the 50 and the 20 are congregating right there. We also have this gap, right? We got this weekly gap. For those of you who like to say the gap fill thing, right? They say we had a gap to fill. Many people like to say the phrase, we had to go there because we had a gap to fill. If you like to say that, then you can then say that when we do that, because there is a gap there. So you can feel like we're filling a gap if that makes you feel good inside. Then after that, we have something similar in our options data. So as we look, right, we can see, oh, look, it's red. That generally means we're gonna go down, because when we don't have calls pinning and reducing our volatility there, right, we have puts instead. This means that traders are going to go ahead and push us. So on the one hand, that means they're anticipating a move to the downside. And number two, they're also encouraging that downside move to happen by positioning themselves with long puts. Remember, as traders are long puts, the dealer is short puts, which means that the dealer is selling stock as the price goes down, and the delta and gamma values on their short puts goes up. Right. So, okay. So they're selling stock, or they're shorting stock, or this is, SPY ETF, as the price goes down, which makes the price go down harder, which makes volatility go up, which makes the put value go up, which means out of the money puts go up in value, which means their delta goes up, which means that the dealer has to go and sell more shares of the stock, which so on and so forth and so forth. So we're not really looking at too much of a crazy cascade here. We do see that there are some decent sized positions below us across all of our expiries. It is position that we should kind of start gliding down there. Right now, it's pretty short term. Out to about June OPEX, it is kind of shifted on that side. So maybe this is something of a 3-ish week. 2 week, we could say, 2 week, but it depends when we reach that. I mean, how much time is it really going to take for us to get down to that level? It could materialize in a week. We could just slip. We could just do it just like that. Just slip it right in there. But in any case, however long it takes, it does seem that we will have something, a reversal at that point, in which point the options market will go ahead and flip back the other way. Volatility is going to go down, and we can get our march back up, maybe potentially to all-time highs to sync up, especially after June, with what's going to go on potentially with raising rates. That's going to start to get priced in even more. It seems like some of that's already being priced in, but get this little correction. People will be nice and happy. They can make some money off a little pullback, and then take that money, reposition, and then get ready for more excitement to come. So, well, that may not be optimal for GameStop, but it's not going to be something of a devastating crash, nothing like that. That may also correspond, and we do see something what looks like to me is, I would say, an attempt to artificiate the appearance of sympathy with a pullback of this sort. So we can see in our price action on Friday, we traded pretty sideways right around basically this lower VWAP channel. We explored the upper bit there, but very sideways. It was an IV killer of a day. Just kind of hung out. And then after hours, of course, we started to slip. This looks like you could say, oh, okay, well, this happened in sympathy with the broader market. What looks to be the case is that this was achieved through the direct involvement of substantial lending liquidity. So if we scroll down, take a look at our lending liquidity, XRT is kind of hanging out there, not doing too much today. But right, if we look, right, you'll recall going into Thursday, we had 5.1 million shares available to borrow. That was an all-time high. That was an all-time high of GameStop shares available to borrow. And here now, heading into the pre-market, heading into the market open, I should say, we're looking at 3.9 million. So as many as 1.2 or 1.3 million shares of GameStop came off the shelf. In fact, we even went down to 3.7 here in the evening. So quite a lot of shares of GameStop were borrowed to what appears to be to adjust the price downward. Right. When we see something like that, when we see all those shares come off the shelf, that doesn't tell me, oh, ETFs that have it or then sell it. No. That's some direct shorting. That's some direct shorting to adjust the price downward. But okay, so what happens there? Well, we do see that even with shorting, there tends to be an attempt or an effort to target some key technical levels at times. We've been moved out of this channel, right? So we're still below it heading into today. What looks to be our destiny potentially for today is maybe some trading in this kind of 4-hour channel here. Maybe very broadly we could head down to the 200, but between the 24-hour and the 50 or the 104-hour, we're sitting right on top of the 54-hour. So maybe we just kind of trade in there. Maybe we get a little bit pulled back to the downside there. Technically, on the daily, does look like potentially the 20-day beneath us is 2750. That's not even that far down there. Those are some potential downside targets. What I will say is in the broader scheme of things, it doesn't look like we're really ready to stop our upward momentum. We're just getting cooking here on the weekly PMO. Daily PMO, we did have the 55 line cross, we're in Kitty's PMO. We had the 55 line cross the 0 line. So that should correspond. That does typically correspond to continued big bullish momentum. And I would say we logged our first 7th consecutive week, so 7-week block of green weeks. So that is a close above the opening in consecutive weeks since 2013, since this guy, which was the squeeze before the squeeze. So this was the squeeze that forced a lot of short closing short closing after GameStop was heavily shorted during the 2008 crash. So that was this. So this big kind of bull shape pattern from 2008, we went right back up to the top of that in 2013. So this also began, we started to do some stuff in late 2012 and then cooled off at the beginning of the year. And then March, right here, right in March is when we started this climb. So we were in 2011, right? So 2012. So in late 2012, right, we kind of came out of this, traded a little sideways in the fall, and then in the wintertime, earnings were good. Console cycle, traded up January, traded all the way back down, got a little thing in February, traded back down, and then in March, we started to move into earnings, and then up we go. And then it was just smooth sailing almost until, I think this was in fact the week of, potentially earnings. No. It was late May. So it would have been the equivalent of this week. So it would have been heading into the week of May OPEX. So maybe if we're really, really following that pattern, maybe we do get a bigger correction this week, followed by a resumption of our move back to the upside there. Not exactly sure what happened May 20th. Good investigation. Right. So right here, we can see volume went up pretty high as well. So not exactly sure what happened, but I don't know. Maybe we do that. That would be cool. I think that would be cool. They should ask me. Call up. Michael, do you think it'd be cool if we just went up? I would say yes. I would say that would be cool. Certified cool in my book. In any case, we do see IV is going up. June is indeed still our leading IV target here. We do see that the week before, so the week of earnings, don't listen to what those guys tell you, right? They're going to try to tell you it's going to happen on June 6th. It's not going to happen on June 6th. It's going to happen on June 10th, 2 days before the annual report, just like they were going to do last year, right? So we were supposed to do it on the 11th last year. Annual meeting was supposed to be on the 13th. Roaring Katie did his thing, had his live stream on the 7th, so we got an early report release on the 7th. That's why they're all like, oh, it's going to happen on the 6th. It's not going to happen on the 6th. It's going to happen on that Tuesday when they originally were going to have it. It's going to happen on Tuesday. And then instead of having the annual report on Thursday, which was the 13th, we had it the following Monday. Why? Because everyone was super stoked about the stonk and crashed the computer share website. So then it happened on Monday. So that will happen. So the week of earnings will be the 13th. Not the 6th, and everybody knows this, right? Even though all of the trading platforms and all the finance sites are going to be like, it's expected on June 6th, it's expected on June 6th. It's not expected on June 6th because look at the IV on the 13th. Oh, it's over 90%. It's our second highest here of the entire chain, except for June OPEX. And it's not the week of the 6th. If earnings were happening on the 6th, the IB for the 6th of June expiry would be very high. And as we can see, it is not. So it's not happening on the 6th. The market doesn't expect it to happen on the 6th. None of the websites that are telling you it's going to happen on the 6th believe that it's going to happen on the 6th. And this is why. So we do see IV hopping up there. That'll be interesting to take into account. Options wise, we did cool off a little bit. Our options chain, understandably, is a lot, well, yeah, it's a lot weaker than heading into Monday OPEX. The distribution of OI is very similar as compared to earlier weeks. We had a decent amount of calls that were sold at the bid. Nothing too exciting in this area. Remember, we still do have some long puts positioned for this week, the following week, and the week of June 6th. Are out there. We did get a pretty good amount of puts at the bid on the 28th. So if we open above 28, we may see some support there, but somebody might try to give us a little shove, try and be a little cautious there. We do have 3 point something, almost 4 million shares available to borrow. Max Payne did move up to 26.50, so we like to see that. We'd like to see that OI kind of shift up there. We like to see that options framing move up, because that's going to tell us where our most predictable areas of price action and of reversal pivot within the day are going to be. And if we take a look at our chart here, right, we can see that. What again is most likely? Again, most likely is going to be 28 up to 30. But you know, we do have a little bit of, we got a little something down here. This is kind of betting on maybe a move down to 27. Things get lower probability here between 27 and 25. I mean, somebody could try to shove us back there. I don't necessarily think that's going to be the case. Seeing stuff in the 27s, I think we could see that. I think we could see a 27 value today. But I would anticipate that as a result of the CAT equity era stuff coming up this week and the FTDs from XRT, maybe FTDs from some of these other ETFs, we do see some more price action going on, right? Some more action, more towards the upside that keeps us into this pocket. Keeps us in this COGEX pocket, trading there, trading stably. Maybe even we see a test of 30. A breach of 30 would take something pretty impressive. It's still a very large position. 18,000 calls at this point versus the 55 we had going into Friday's trading. So yeah, I mean, that's more or less what I'm thinking right now. As I go into the week, I'll be thinking about trying to figure out and discern whether we're seeing, depending on what happens intraday, trying to discern exactly maybe where some of this buying volume is coming from. But that's basically my outlook here. Certainly looks exciting. Not trying to get too, euphoria heavy, anything like that. Obviously trying to do this soundly, trying to understand where our highest points of predictability are and to plan my trades accordingly with respect to that, as well as trades that are complementary to my investment in the underlying fundamental company that is GameStop. So yeah, going to be an exciting week. An exciting week in terms of the company, in terms of what's going to happen with our price action. Sure. A lot of reasons to be pretty stoked about it. So yeah, definitely looking forward to seeing what this week has to bring for us, as well as looking forward to seeing everybody, here in the comments over on X, and definitely at our live stream this coming Friday. So we will see you guys then, there, all the times, and thank you very much. We'll see you.